Yeah, and I could give a very specific example of exactly the two tax traps to avoid and the three things to do to save on tax that will boost that bottom line. And there's three other ways than just saving tax that helps people become efficient immediately, that might just take a little bit of, knowledge and insight, but doesn't take the excruciating work to boost revenue. So here's the tax traps to avoid. I already talked about one. Don't just delay or defer taxes, because if you don't have an exit strategy or know how you're going to get to that money, you might put yourself at a higher tax rate in the future. Number two, don't spend $1 to save 40 cents. Don't let the tax tail wag the dog. It doesn't make sense to go, okay, I once had this guy call me in December and he was like, hey, I need to buy something because I just found out I owe an extra $251,000 of tax. I'm like, how'd you just find this out? He goes, well, in November, I had a huge event. We did really well, better than expected, and my accountant wasn't prepared for it. So he tells me that I'm now owing extra $251,000. I'm like, well, what would you have bought if you didn't get this news? He goes, nothing. I'm like, well, then we're not going to buy anything. In that situation, he was a consultant, so we used the accrual method of accounting, which moved his taxes into the next year and gave us an extra 13 months to figure out the tax strategy, which we're able to reduce by basically $249,000. So he only had to pay $2,000 of tax because he wasn't paying himself properly, and I'll give the rest of that framework. So there's the two tax traps to avoid. The three things to do. The first one is to be proactive. You start building an accounting team, which the more revenue you have, the more likely you need a tax attorney and not just a CPA. And if you own a building, you need a cost segregation engineer. So you could have an accounting team of maybe up to 3 people, but you meet with them at least quarterly, and you start going over your information ahead of schedule, rather than at the end of the year, or rather than between January and April, which is kind of the brain dead season. So by being proactive, you can start to ask them the other two factors here. Number one is ask them to go back the last 3 years and see if you missed out on any tax deductions or if you overpaid tax, because you can amend your returns. In 2006, I had 2 business partners die in a plane crash. For 4 months, I didn't even speak to an accounting professional. I didn't get him any of my information, which meant I overpaid my tax that year, $54,000. Fortunately, every 3 years, I go look back, and I found out in 2008 that I had overpaid $54,000. So the IRS wrote me a check rather than me writing a check. So I got $54,000 back through amending. So that's one piece. The second piece is, on that phone call, you just want to sit there and ask questions like, what additional things could we be doing to save tax? What have you done to save some of your other people tax that you're working with? Is there any new laws that have come out? Is there any way that we could be creative? I don't want you to do anything illegal or unethical, but at the same time, I don't want you to tip the government. Just pay what your fair share is. So the other two factors that help you save is, most business owners don't take enough deductions. Any expense that can be related to the business can become deductible. So every month, I want you to look at all of your expenses and say, was it related to the business? And as long as you document it, you can start taking additional tax deductions. Let me give some examples. If your kids are supporting you in any way in your business that are 18 or younger, you can pay them up to $6,300, where you get to write that off for the business, but it becomes a tax deduction for you. That's turning an expense into a deduction. Or let's say that you host clients or employees over to your residence. You can rent that out 14 days a year to your business, write it off as a tax deduction, but not have to claim that as personal income. Especially, if you live in an area where there's some major event going on. I happen to live in Salt Lake City, and we have the outdoor recreation show every year, and the hotels go up 3 times in price. I always host a function at that time, and then I get a write-off of a really big chunk of money. And right now, I'm coming from my home office, not my actual office, where my entire business is housed. So I'm writing that off, but I'm also writing off this jacket because it's a uniform. I don't wear this normally. I'm wearing it because I'm on a podcast that you guys can see me on. So I'm writing that off. I mean, there's so many opportunities there, and most people are missing so many deductions. So that's a big way for you to save. And the third way to save on tax is to reclassify income. Your active income, which is anytime you're paying yourself a W-2 from the business, is your highest taxed income. You can have self-employment tax of up to 15.3%. You can have additional tax on Medicare, Medicaid once that's maxed out. And then above $250,000, you can have a success tax that costs you 3.7%. But anytime you take distributions rather than salary, that isn't taxed like that. Or anytime you can get capital gains instead of ordinary income in today's environment, that could cut your tax in half. So there's so many ways. Like if you own a building, you want to charge yourself the highest possible rent. that you can show as a comparable, because that's going to come through as a 1099, which will be taxed less than a W-2. So any ways that you can reclassify income is going to save you substantially, and there's so much opportunity on that. So I just wanted to give a little bit of a framework and a little bit of specific examples and ideas. I gave you like 4 or 5 specific examples. There's probably 400 things that most people could do that they haven't even thought of or haven't even considered, because most accounting professionals are reactive in nature instead of proactive, because they become filing machines. They get really busy. And this is why family offices, for people worth 50 million or 100 million or more, they get some of the best accounting professionals in the world, and they're not working with hundreds of clients, they're working with handfuls, and there's a lot of money that can be saved.
So, you brought up some incredible examples, and one of the ones I want to kind of dig a little deeper on is you talked about writing off things, which is a big gray area for a lot of people. Like obviously you go to for the most part, when you're a normal business, not $1 million business up, we're talking about you don't have an accounting team, you have just one accountant or someone you use to do your taxes. They're typically, forgive me for saying, like very afraid, or I would use a different word than that, but they're afraid of making any moves that could trigger any type of audit or any type of red flag for any reason. So, a lot of business owners typically fall back down and they say, well, I can't do this, I can't do that, my accountant doesn't think it's the right thing to do. Where or how do you draw that line to know what is really a gray area that is okay to navigate versus a gray area that is not okay to navigate, because it is most likely that the accountant is correct and a conservative approach is best?
So let me give you some gray areas that I'm not judging whether they're right or wrong. I'm just saying they're gray and they're increasing your chance of audit. One is when you do things offshore just for tax reasons. If there isn't a true business purpose, that's going to be gray areas that will increase your likelihood of audit. Let me give an area that can be gray, although I've actually recommended it at times, but can increase your chance of audit. One of the ways that people can reclassify income is if they have a business that has a bunch of different risks, they can set up their own insurance company. And right now, you can put $1.2 million into it. It's called a captive insurance agency. It's a C corporation, and they're moving that up to, it looks like, $2.2 million. But these are something that all the time increase people's chance of audit. Now, I'm not as worried about an increased chance of audit. I'm worried about if I'm doing something illegal that would harm me in the audit. So the first way that you can arm yourself in an audit is you have good documentation. The second thing is avoid complex structures that require private letter rulings that aren't just a normal part of the tax code. So there was a thing in insurance called a 412I where people could deduct their insurance premiums where normally that's not a deductible expense. That's a gray area. You're taking something that already has tax benefits and trying to couple and add additional tax benefits. That becomes an issue for the IRS potentially. And by the way, there were things even more aggressive called 419 plans that got attacked and unraveled, and some people actually had major fines and did jail time over that. So I don't like private letter rulings as just a general rule of thumb when it comes to my tax situations, but everything I can do within the law and I can document that it's part of my business, I don't worry about. So I've been audited twice in my life, and we have a formula. When we're audited, we treat the auditors with respect. We give them everything that they ask for in an organized and more than timely fashion, and even give them additional insights and information and context to anything. And when we're treating them well, anything within the law, if we can feed them, we're going to feed them. If we can give them a great conference room, if we can, just treat them with nice respect, because most people are afraid or they're antagonistic, and that's not the way to treat those individuals. And then when the audit's complete, we start asking for additional deductions. Could we write this off? Were we aggressive enough here? This is related to business. And most of the time, not all the time, most of the time, we actually save people more during that audit. So if you have a good accounting team, then there's nothing to worry about. If you don't have a good accounting team, and here's how you know you don't have a good accounting team. Accountants that say that they're conservative is another word for antiquated or lazy, or it's their excuse if they miss a tax deduction. You don't want a conservative accountant. You want an ethical, legal accountant that will be as aggressive as the law will allow them to take advantage of all your deductions. So let me give other examples of reclassifying income. Let's say you have a business that earns a lot of money, but it has peripheral side businesses that support it. An example is we work with a lot of health professionals. So they might be a chiropractor, but they also do supplements. But that supplement revenue is, let's say, less than $50,000. We could set up a C Corp just for the supplement business, and the first $50,000 you earn in a C Corp is taxed lower than an LLC or the S Corp is right now. Now that could change with new laws, but all of a sudden we've reclassified that income. That's just the law. It's exactly what the IRS states. It's not taking anything offshore. It's not adding a lot of complexity. It's just taking advantage of exactly what they've stated are the rules. Now, I've had CPAs say, well, how do you take deductions for a uniform? Well, I'm on video, I'm on stage, and I'm just showing those kind of things. And I have those uniforms, which are suits or which are just ties or vests that are hung up at my office that I'm not wearing out when I'm hanging out at my house. So that's really easy. Or if I'm taking a trip and I'm doing a little bit of business, I just make sure to put that documentation together in a folder on my email. Or I make sure to write on my American Express bill what things were used for and why, so that if I ever get audited, I can just show what that story was attached to. Know this, if you're a C corporation, you have a higher likelihood of having a more seasoned and more aggressive auditor. If you're an S corp or LLC, you're more likely to have a rookie and someone that is less likely to battle your deductions. But here's the thing. If you have a deduction that's greater than 20% of your overall deductions and it's disallowed, it can have a 25% penalty. If it's less than 20% and it's disallowed, it's typically like a 9% penalty. To me, it would be worth having small things disallowed if I was uncertain rather than overpaying on tax. But then again, I'm going to ask my attorney, my tax attorney or my accountant, what I can write off and what I can't and why and what rules support that. And that's what I do on my quarterly meeting, because I'm not a CPA. I just happen to be in the financial world, and we're really good because we have CPAs in our network as saving people on tax.